Britain on the verge of recession as the credit crunch continues to bite. Who got us into this mess?
I think the people in charge of those banks live in a different dimension than the rest of us. It's money monopoly for them, and the rest of us, I'm afraid, are victims.
Tonight on Dispatches, who are the winners and losers of the credit crunch?
We're all paying the price for the mistakes. The bankers don't seem to be paying the price.
Whose fault is it?
I think the banks need to take a long, hard look at themselves, and I think they're entirely to blame.
Are the bankers looking out for their customers or themselves?
I never thought about anything other than next year's bonus. You think about nothing else. And that encourages short-term gambling.
Ultimately, the banks never lose, but we do.
They want to make as much money from the customers as what they can. And it's always the customers that are paying, always.
I'm James Max. I worked in banking over there in Canary Wharf. I used to have faith in British banking, in the high street names we all know so well. But along came the credit crunch, and now we're having to pay for their mistakes. If you've got a bank account or a mortgage, the chances are it's with one of the big five. Barclays, HSBC, Lloyds TSB, HBOS and RBS. Most of us hold an account with at least one of them. They also have 44% of the mortgage market. At the peak of the housing market in 2007, all banks were competing to lend money. £362 billion was lent in mortgages. Now the credit's dried up, the Council of Mortgage Lenders has already warned that repossessions will rise by 50% this year to 45,000. The Isle of Wight is home to one of the faces behind those statistics. Charity worker Steve Lewis has lived in this house for 17 years, but he won't be there for much longer.
Today is the realisation that I've got 6 more days and 17 years worth of money and life and memories is gone.
Steve's house is being repossessed because he couldn't afford to pay the increases in his monthly mortgage payments.
To go from £400 odd to 700 odd, nearly 800 is, well, it's extortionate.
All Steve can do now is to try and get everything he owns out of the house to avoid further costs.
I've had to throw away not just rubbish, I've had to throw away personal stuff that I obviously can't take to my next accommodation, which will be much smaller than this. If I leave anything here, when the bailiffs arrive, they'll charge me for the pleasure of removing any of my possessions, including my shed. So God knows how much it's going to cost me altogether to actually have my house, be it not the best house and not the best looking place, but it was mine, gone.
Steve isn't alone. The banks are taking an increasingly tough stance with people who find it hard to pay their mortgages. There are 302,000 mortgage payers currently in arrears in the UK, and over 9,000 homes have been repossessed in the first 6 months of this year.
At the moment, I'm homeless. I haven't even got a masonette or a flat to live in.
Since filming with Steve, the court has given him a reprieve, and his lender, HBOS, has told Dispatches that he has not been repossessed. Yet. The ultimate responsibility for the credit crunch has to lie with the people at the top. The chief executives whose banks got involved with subprime lending or loans to high-risk borrowers. And now the results of that are in. This year's performance by the big 5 high street banks has been appalling. HSBC profits fell by 28%, £2 billion less than last year. Barclays profits down by 33%, £1.3 billion less than last year. HBOS profits down 51%, £1.5 billion less. Lloyds TSB profits fell 70%, down £1.4 billion. And RBS didn't even make a profit this year. They lost £691 million.
I think that the boards, including the chief executives of a number of high street banks, frankly carry quite a lot of responsibility for what's gone on. In many cases, they didn't properly understand the risks they were taking, and in some cases they didn't even bother to make sure they were properly appraised of the situation in terms of getting up-to-date information. I think all the signs are that this has been a classic management failure.
You can blame the traders, you can blame the lenders, you can blame all the people, but there are people at the top who are paid vast sums, and their job is not to trade, is not to lend, their job is to oversee. And those people are the chief executives. And unfortunately, I think they took their eye off the ball.
They may have taken their eye off the ball, but they're still in their jobs. Are you a customer of Lloyds? Their decisions affect everyone. Yet, how many of us even know who they are?
Do you know who this man is?
No.
No. He's Sir Fred Goodwin.
Okay.
Who's chief executive of RBS, your bank. Do you know who this man is?
I don't know, who is it?
Shall I tell you? It's John Varley. He's the chief executive of Barclays. His name's Eric Daniels. Yeah. Does that ring a bell?
No.
He's the chief executive of Lloyds TSB. Do you know who this man is?
No idea. I haven't got a clue.
Chief executive of Halifax Bank of Scotland. His name's Andy Hornby. His name's Michael Gagan. Does that ring any bells?
No.
He's the chief executive of HSBC.
Right.
As no one seems to know who these incredibly powerful figures are, I've made it my mission to try and speak to them. I've written to each of the chief executives of the big 5 high street banks to see if they'll give me an interview, as they haven't done any since the credit crunch began.
Gordon Brown has been making further attempts to restore confidence in the financial system. This morning he had a meeting with leading bankers in Downing Street.
One of the few times these men were exposed to the limelight was last April. As the credit crunch reached crisis point, 30 senior figures from British banking were invited to Downing Street for a breakfast meeting. It was assumed that the Prime Minister would want to call the bankers to account. The chief executives of the Big 5. Michael Gagan of HSBC, John Varley of Barclays, Eric Daniels of Lloyds TSB, Andy Hornby of HBOS, and Sir Fred Goodwin of the Royal Bank of Scotland were all there.
There was a full breakfast laid on. I'm reliably informed that all that Gordon had to eat was a rhubarb yoghurt, but there was a full spread brought in: scrambled egg, tomato, bacon, the whole works.
The bankers came armed with an agenda. They wanted government money. Within days of the meeting, Gordon Brown agreed to make £50 billion of taxpayers' money available to underwrite the bank's bad debts.
The banks have always been keen for, government to stay out of their affairs during the good times, and it is perhaps a little bit rich to come back with a begging bowl when things get tough. But the facts of the matter are that when banks get in trouble, we all get in trouble. We can't really afford for banks to get in trouble, and governments can't afford for banks to get in trouble. And that's kind of the way it works.
This is real money that won't now be spent on schools and hospitals. This is real money that real people and real businesses are writing cheques for when they do their tax returns. So we're in a situation where the banking system has made the mistakes, but because the banking system's far too important to fail, it's the rest of us that are picking up the bill.
And £50 billion is just the start of it. It could be more.
The figure of 50 billion is touted about. That's not a maximum. That's a sort of starting point in a way. And that we will never find out who borrowed it. So, for example, one day under the 50-year rule or something, we'll know the real truth about the application, about Britain's hydrogen bomb. We will never know, ever, who borrowed money from the Bank of England.
The government don't want you to know which banks are borrowing money from them, because it reveals which banks have bad debts. That can lead to panic amongst customers and a run on the banks, as happened so spectacularly with Northern Rock. Northern Rock got the ultimate bailout, nationalisation, but it's still making losses, more than £500 million in the first 6 months of this year. Northern Rock were well known for handing out mortgages at high income multiples, but they weren't the only ones. Dispatches has learnt that in 2006, the most recent year for which figures are available, over 1 million mortgages were granted on a multiple of 6 or more times the applicant's income. That's nearly 1/10 of all mortgages in the UK. The number of mortgages granted on a multiple of more than 10 times the applicant's income was nearly 38,000.
Don't jump too high with your sister, and see.
I'm on my way to meet a family who are caught in the middle of these extreme mortgage lending practices.
I'm James.
Hello.
Hello.
Come on in.
Thank you very much.
When Hilary LaRue and her husband borrowed £170,000 to buy this house in Northamptonshire, it seemed the ideal home to share with their 2 children, Kira 3 and Connor 4. But the mortgage they used to buy it was far from ideal. Hilary is one of 200,000 people in the UK with a Northern Rock Together mortgage. The LaRues borrowed 4.5 times their joint incomes, and because they needed extra money, it was also for a massive 125% of the value of the house. It was instant negative equity.
It is obviously risky to take 125% of your mortgage, but we needed the house. We needed to go up a size because our previous house was 2 bedrooms, and this is obviously 3 bedrooms.
When her initial fixed-term deal ended, Hilary had to change her mortgage to interest only, but the monthly payment still went up by £120 a month. Hilary's husband works full-time as a mechanic, and in order to meet the higher monthly mortgage payments, Hilary has 2 jobs, a weekday admin job and a weekend courier job, on which she has to take her children with her.
So how many days a week are you working?
We can probably say 7 days a week.
And that's because you want to stay in your house and you somehow want to keep up with the repayments.
We do. We definitely don't want to obviously have, you know, our names blacklisted or anything like that, obviously by repossession. We want to keep our names clear, and we want to keep a lovely house, you know, and let our kids grow up in a lovely neighbourhood. I mean, it's a house that we really do love, and we've obviously working as hard as we can to try and keep it.
If Hilary and her husband do fall behind with their mortgage, they can expect no mercy. Northern Rock have already repossessed 3,710 homes in the first 6 months of this year. That's 180% up on last year.
And do you have a real worry that you may end up losing your home?
We do. That is a worry for us of obviously, you know, 1 month having a really rough month and not bringing in as much as what we could afford to pay on the mortgage. So yes, it is a worry that we fall into arrears, and then obviously, you know, Northern Rock is very aggressive at repossessions as well. So we've got that added worry as well, that if you fall 1 month behind, they will start proceedings as well. So we are worried, and we want to try and keep a roof over our heads.
Northern Rock told us that they always try to reach a reasonable agreement with customers in arrears, and repossession is a last resort. There seems to be no alternative for Hilary and her family. As other lenders have withdrawn from lending more than 95% of a property's value, Hilary is locked into Northern Rock's high standard rate.
I mean, how does it make you feel that the Northern Rock had to be bailed out by the government, it's now nationalised, but they're charging you nearly 7.5% rate of interest when the Bank of England is charging 5%?
That is very, very irritating, and you know, it makes us quite cross as well, because they've been bailed out, so therefore they're charging one of the highest standard variable rates. I mean, there's other banks that are on, you know, 6% odd, and they're charging 7.49%. They want to make as much money from the customers as what they can, and it's always the customers that are paying, always.
Whilst Northern Rock borrowers are paying the price in higher interest rates, Adam Applegarth, the chief executive behind the bank's disastrous lending strategy, resigned last year without offering a clear apology.
Do you actually accept you've done anything wrong?
I feel great regret for the anxiety our retail customers have seen. It was a good business model, but clearly couldn't deal with the unforeseen global freezing of the liquid market.
And he continues to be paid £63,000 a month in severance pay, and can look forward to a £2 million pension fund, so while the bank's borrowers pay the price of his decisions, he can afford to spend time playing his favourite game, cricket. I'm following up my letters to the big 5 high street banks with phone calls to see if I can get interviews with the chief executives.
Is there a reason why he refuses to do broadcast interviews? And I'm happy to meet anytime, any place, anywhere. Is there absolutely no way that you can possibly get half an hour for us?
It's not looking very hopeful.
Okay, is he anywhere to be found, or is he... Oh, okay. So he could be back at any time or never, perhaps. If you're prepared to provide resources away from the camera, what's the problem with providing those resources to the camera? Well, that was the press officer for RBS. Sir Fred Goodwin apparently rarely does any press interviews at all. The last time he did so was 2 years ago to a news agency.
Sir Fred Goodwin is the chief executive of the Royal Bank of Scotland. Last year, his salary was £1,290,000, before bonus. None of the big 5 banks has responded to my letters and phone calls with the offer of an interview. So I'm going to try and approach each one of them in person. First stop, RBS headquarters in Edinburgh.
Excuse me, do you have a pass, sir?
I don't have a pass, no. I wondered if I might have a word with your chief executive, Sir Fred Goodwin.
If you would just like to have a seat here, sir.
Of course. Thank you very much.
Sir Fred Goodwin has told shareholders he regrets the bank's losses of £691 million. And he's chastened by overseeing the second biggest loss in British banking history. Still, they're very hospitable here.
Like some tea or something, gents, where are we?
Well, I don't, Mike. Do you want some tea?
Some tea? I'd love a cup of tea.
Yes, a cup of tea would be lovely. Yes, please. Why not?
But now they're keeping me waiting. And waiting. And waiting.
And maybe they operate on different timescales here.
Have they forgotten me?
I've been here for quite a while now.
I know, I do apologise for the wait, sir. As far as I'm aware, there is somebody from Media Relations that is certainly on their way down.
Oh, not Sir Fred?
Oh no, it will. We contact Media Relations and then they take it from there, sir. So they should be on their way down very shortly. I shall chase them, though.
If you wouldn't mind, I mean, we've been here. The group media officer.
Looks like people are starting to go home.
So 10 minutes after they tell me that there's somebody just on their way down, I'm still waiting.
No, I'm going to call the group media officer myself.
Categorically, absolutely and completely, there is no way whatsoever that Sir Fred will agree to speak to us directly. Is there any particular reason that you don't do press interviews? I mean, is it because he's busy or just doesn't like them or doesn't feel that he wants to communicate with his customers?
Excuse me, can I ask you a very quick question?
In part 2, we're going to see how the banks and the bankers carry on making money and the damaging effect of the big bonus culture.
I never thought about anything other than next year's bonus, and that encourages short-term gambling.
Do you know how much bonus, in addition to his salary, he received last year?
No, but probably a lot.
I'm trying to find out if high street bank customers have any idea of the size of bonuses that the bosses of their bank earn.
Extortionate amount.
And I just wondered if you knew how much of a bonus he received last year.
I don't.
$500,000? No. Shall I tell you? £2.14 million bonus.
Lucky fella, eh?
Something scandalous, probably. Very scandalous.
I can't find anybody who does.
So give me some numbers.
I don't know, 10,000?
£1.4 million bonus.
I knew it was going to be 1.4 million. Nice.
Are you shocked by that amount of money?
Yeah, I don't think people should get that amount of bonus.
I've just had my increase and backdated. I've got £4 a month.
One of the attractions of working in banking is that if you're good at your job, you're well rewarded with a very big bonus at the end of each year. Which is supposed to be an incentive for doing a good job. Now, I've got nothing against bonuses. After all, I bought this Aston Martin with some of my bonus money. But the big banking bonus has become so routine that sometimes it's even given to people who made the wrong decisions.
The average person in the street would find it difficult to understand how you can lose billions of pounds in irresponsible investments and lending, how you've created, and they have fueled and created, a lot of debt both in our own economy and elsewhere, and that the price of that is, for them, is to walk away with suitcases full of cash as bonuses.
The average bonus paid to a UK worker is £1,800. But the average bonus paid to those working in finance is £12,000. But that figure is dwarfed by the astronomical sums paid to those higher up the chain. This year, 4,000 city executives took home a bonus of more than £1 million each. This year's city bonus bonanza totaled £13 billion. That's even more than last year, so it hardly appears to be performance-related pay.
I do think there's a case for the heads of banks that have undergone significant losses, particularly where it looks as though senior executives have made critical mistakes. I think there's a sound case for them giving up their bonuses.
So, what do the bankers do with all that cash? They buy luxury houses, in places like this for a start. This Surrey property is on the market for £2.1 million. The owner, Jeremy, is a former investment banker and fully expects it to be bought by a banker with a bonus.
Hello, James.
Jeremy, nice to meet you. Thank you very much indeed. This is marvellous.
Thank you. Welcome to Three Gables.
So what are the sort of people who would buy a house like this?
Well, this area of Surrey is traditionally known as Stockbroker Belt, and that gives you a clue, really. If you go down to the station at 7 o'clock in the morning, you will find a very, very full platform of people heading up to the city.
Are you seeing people who are still able, through the bonus that they receive, to be able to come and buy a house like this for cash?
Well, it's a combination. It may be money which has come as a result of bonuses, but equally it can be money that's been realised through the appreciation of their existing property. So a lot of people will be bringing bonus money to this market for sure, but a lot of people will be bringing equity in existing properties too. So it's a combination of those two.
When you bought your house here, which you said you bought a few years ago for £1.75 million, you're obviously working for an investment bank shortly before that. How much were you able to pay off this particular property with cash from bonuses?
Well, I wouldn't necessarily want to go into exact amounts, but we certainly did not require a great deal of financing to buy this property, no.
And a big banking bonus can also pay for a decent set of wheels.
So how old are the sorts of people who are coming in to buy these cars?
Well, really from 25 up to about 45, I would say, is particularly from the city. These are the guys who are generating a lot of income, a lot of wealth, and actually big bonuses invariably.
So hang on a second. So there are people in their 20s who are coming in with enough money from their bonus to be able to buy a car like this outright with cash?
Yes, and by the way, we've now got a lot of girls buying cars as well, who are brokers, bankers, you know, several now buying used cars.
If I wanted to buy, I don't know, a top-end convertible Ferrari or a Maserati, how much money am I talking about?
Well, you could be talking up to £200,000, around that sort of figure.
And these people have that money in cash from their bonuses?
Yes, indeed. Yeah.
Does it ever stagger you how much money these youngsters are being paid?
Well, it doesn't really, because you have to understand that at the very top end of the market, in other words, people with exceedingly huge sums of money that they've generated, particularly in recent, say, decade, are quite capable of buying, you know, £1 million motor cars. And so younger people paying £200,000 for a car is not an extraordinary thing for us anymore.
The city bonus culture encourages short-term risk-taking, something Mervyn King, the Governor of the Bank of England, has recognised as damaging.
I think that banks themselves have come to realise in the recent crisis that they are paying the price themselves for having designed compensation packages which provide incentives that are not in the long-run interest of the banks themselves, and I would like to think that that would change.
Liverpool Street Station. Many bankers pass through here on their way to work. I want to find out what bankers themselves think about city bonus culture, if I can get them to talk to me.
Excuse me, sir. Do you work for a bank? Excuse me, sir. Do you work for a bank? Excuse me, sir. Do you work for a bank? Do you work for a bank? No, I don't. No. Lawyer. Six figures?
I can't say. I just realised that my colleagues never saw this on here.
I'd rather not, actually. 5, 6 figures? You never know. Go on, give me a clue. Give me a taster.
But just when I was going to give up, I hit the jackpot.
5 figures, 6 figures? Not 7 figures. 6 figures. Higher 6?
Just 150.
Really? It's quite a lot. And then for the guarantee. Pretty good deal. Thank you, sir.
Nobody really wants to talk to me openly about their bonus. I'll have to find a whistleblower. Geraint Anderson worked in the city for 12 years as an investment banker. Today, he's going to lift the lid on the city's secrets and give me the inside track on bonus culture.
Hi, mate. Very nice to meet you. James Max. Let's do that.
In the city, your worth is judged by the size of your bonus. You are doing everything to maximise your bonus, and therefore you are making sure that everyone knows you've got a massive bonus. Most people spend it on, in the city, the usual things. We're talking about Ferraris, we're talking about lovely holiday homes in Tuscany, we are talking about the second home in the country, we're talking about Oswald Boateng bespoke suits which cost £3,000. The bonus culture is absolutely central to this whole thing. After 12 years in the city, I can say with hand on heart that I never thought about anything other than next year's bonus. And that encourages short-term gambling.
And it's these bonus-driven gambles that helped create the credit crunch.
The problem is that the economic and financial cycle takes quite a long time to play out. Depending on events, it might be 10 or 15 years before a financial crisis hits as a result of things that have gone on before. Now, bankers, by contrast, are rewarded on simply doing deals now. And if you do the deals, the risks emerge later. You might have retired, died, moved on to another bank, all sorts of things might have happened. And you've had your squillions paid out to you in bonuses. And it's a one-way bet. Things go well, you make money, you get paid the bonuses. Things go badly and the bank loses money, you're not asked for the bonuses back. This is a very, very peculiar incentive system, and I'm sure it's played a major role.
There was an unspoken truth out there that it would go wrong someday. But by then, you'd have your bonus, you'd have built your conservatory, you'd have bought your car, you'd have paid off your mortgage. So who cared about the future when bonuses were now?
Michael Gagan is the chief executive of HSBC. Michael's salary last year was over £1 million. and that's before you count his bonus.
Yes, I come to see Michael Gagan.
Michael Gillian.
Michael Gagan.
Yeah, Gagan. So you are a visitor, sir?
I'm sorry?
Are a visitor, yeah?
Yes.
So can you go and sign in the registration, please?
Okay.
Michael Gagan also got a bonus of £2.14 million last year, on top of his £1 million salary, despite HSBC having to write down £9.5 billion of bad debts.
I'm here on behalf of Channel 4's dispatches.
Michael Gagan isn't available to give me an interview, but in HSBC's annual report, he wrote that in these uncertain times, HSBC has a clear and focused strategy, and growth in their emerging markets has been considerable. The Bank of England base rate is currently 5%, but we'll have to pay well above that on our mortgages. That's because at 11 a.m. each weekday morning, behind closed doors, the banks collectively set the rate at which they can borrow from each other. They call it London Interbank Offered Rate, or LIBOR. This is the rate that determines how much our mortgage will cost us.
My prediction, my fear, is that for the next 12 months at least, we're still going to have this big gap between base rates, as set by the Bank of England, and the interbank rates, the LIBOR rates, as set by the banks. And that's because the banks, unless they have a sudden crisis of conscience and fess up all their subprime loans, they still won't trust each other, that some of them won't have smouldering in their balance sheets big subprime losses. That will keep the interbank rate high, and that will mean that mortgages stay expensive for the next year at least, in my view, if you can get a mortgage.
The high street banks have already figured out how they're going to get back the billions they lost in the credit crunch. From us, their customers.
Banks have lost a lot of money. They have to rebuild their asset sheets, their balances, and the only way they can do that is by paying a little bit less on their savings to savers and by charging a little bit more in fees and interest rates to people with mortgages. It's grossly unfair, but that's how the system is.
And as mortgage interest rates rise, then the banks make more money from the loans they've made to homeowners, bringing in much needed cash. We asked independent analysts, Moneyfacts, to calculate how much more money the big five banks could be making from their customers through higher interest rates. Based on the interest rate rises for each bank between the 1st of July 2007 and the 1st of August 2008, on an average £150,000 mortgage and the number of mortgages that each bank has, Moneyfacts has calculated that over 1 year RBS could have made an extra £158 million, HSBC £219 million, Lloyds TSB an extra £411 million, Barclays another £500 million, and HBOS could have helped themselves to an extra £1.5 billion. Andy Hornby is the chief executive of HBOS. Last year, he earned £940,000 before bonus. I'm at the HBOS HQ in Edinburgh to try and see him in person.
Hello there. Yes, I've come to see Andy Hornby, Chief Executive. I just wondered if you might spare 5 minutes with me.
I don't think he's in actually, but is that running?
That is running.
Just switch it off then if you'd like to come in. Or you can wait there and you can go in and ask.
OK, so we can switch it off and I can come in and ask and see if Mr Hornby is around.
Well, you can ask in reception what you want, but he's not coming in if it's running.
Andy Hornby is not available for an interview. So I can't ask him why HBOS was so short of cash that they had to ask their shareholders to help them raise £4 billion in a rights issue. In the HBOS annual report, Andy Hornby has said the bank is now well positioned to compete in today's more challenging economic environment. John Varley is the chief executive of Barclays Bank. Last year, his salary was £975,000 before bonus. My letter and phone calls haven't produced the offer of an interview. I'm at Barclays Canary Wharf HQ to try and meet Chief Executive John Varley.
I'll come to see John Varley, your Chief Executive.
OK, let me just...
I want to ask John Varley about the £2.6 billion worth of bad debts that his bank has had to write down over the last year. I won't be able to ask him about it today. John Varley told shareholders that they have endured a lot. He's acutely disappointed by the fall in profits and has promised to improve the bank's position in the future. We're now a year into the credit crunch, and Britain's big 5 high street banks have between them written down losses of £20 billion. I'm trying to talk to the men who run the banks, the chief executives, to find out why we're paying for their mistakes. I've tried and failed to get an interview by writing and calling, so as a last resort, I'm making a more direct approach. To complete the set, I want to try and see Eric Daniels, the chief executive of Lloyds TSB. He earned £960,000 last year, not including his bonus. Lloyds TSB fared better in the credit crunch than the rest of the big 5 high street banks, but they still wrote down £667 million of bad debts.
Hello there, I've come to see Eric Daniels, your chief executive.
In their annual report, Eric Daniels has said that Lloyds TSB's capital is very robust, and that should help the bank weather the storm.
I've just come out of Lloyds TSB. The press department insists once again that Eric Daniels, the group chief executive of the bank, has absolutely no intention of speaking to me whatsoever.
It's as if the chief executives of the banks are remote, obscure figures in their ivory towers who feel no need to be accountable to the public. So who do the big high street banks answer to? You might think that the Bank of England is responsible for regulating the banking system, but not anymore.
In 1997, Gordon Brown set up the FSA, the Financial Services Authority, to regulate the banks and protect the public. But the FSA is funded by the banks, and their chief executive is an ex-banker. It's come under criticism by a committee of MPs. They said that the FSA had systematically failed in its duty as a regulator over the whole Northern Rock fiasco.
The regulator showed no real interest in all these toxic securities and the risks that were being taken. And I think that goes back to the founding of the Financial Services Authority. It was set up in the spirit of a service industry, in a way, by Gordon Brown when he was Chancellor in 1997 and 1998. Its aim always seemed to be providing a service to the city and to banking, rather than policing it.
Former investment banker Hector Sanz is the chief executive of the FSA, with a salary of £417,000 a year. Although Hector Sanz has criticised big bonuses for bankers, in the year of the Northern Rock fiasco, he got a bonus too, a cool £114,000.
Hi.
Hector Sanz wouldn't see me, but an FSA spokesperson told dispatches that their supervision of Northern Rock prior to summer 2007 was unacceptable. But they did reassure us that they have learnt the lessons from this failure and have implemented a supervisory enhancement programme. They also said their supervisory achievements over the past 12 months have been considerable. So the chief executive of the FSA doesn't want to talk to me. But what about the government? Surely, in these tough times of rising mortgage rates and falling property prices, you might expect that Gordon Brown and his colleagues would wish to do more to curb the extravagant bonus culture. But you'd be wrong. Treasury Minister Kitty Usher told bankers,
"We will resist the calls that have been made for direct regulation of executive pay. I'm clear that executive pay is a matter for boards and shareholders, not for governments and regulators."
But some Labour figures believe the government needs to take a much firmer line with banks.
I think New Labour's relationship has been built on what's called a light regulatory touch. I think that's a polite euphemism. I think it's virtually non-regulation. I think more or less whatever the city wants, it gets. One example of this, of course, is what happens to people when they leave office. And one does notice that Tony Blair has now been given a job offer by JP Morgan. I'm sure there's nothing corrupt or improper in that. I'm not suggesting that. But I think that suggests that there is a very close working relationship, a symbiosis of interests between the politicians and the big financiers. That appointment, I think, really probably does sum it up.
The government has recognised that some reform is needed to strengthen the framework for financial stability and depositor protection. This October, bank reform legislation is to be introduced, which includes giving explicit legal recognition to the Bank of England's core responsibility of financial stability, implementing a range of measures to supervise financial institutions, and changes to the compensation scheme to make it easier and faster to pay off depositors in the event of failure.
So it's only the biggest financial crisis of our lifetime, but the banks won't talk to me. The regulator won't talk to me. And the government won't talk to me. Will anyone talk to me?
Well, there is someone, the spokesperson of the British Banking Association.
I've asked to speak to the chief executives of the UK's top 5 banks, but all of them are refused interviews. Do you know why that is?
Well, they certainly speak to quite a few people, after all, their shareholders, as one obvious group of people that they speak to, and they've done a variety of interviews in newspapers and radio, so I suppose it must be something you said.
We've interviewed many financial commentators and city experts who have said that the bonus culture has significantly contributed to the credit crunch. What's your view?
You do have to actually remunerate people well, and especially when times are difficult, you know, you need good, competent, well-experienced people, and they will need to be well remunerated. But do we think, as an industry, that bonus culture, the risks and rewards, weren't judged right? Yes, we do think that there's something that needs to be looked at there.
The buck surely stops with the big bosses. Why haven't any of them resigned?
Do you say to your most experienced bankers, we've got a global problem, so we don't want you to be involved? Would strike me that would be a very surprising decision to make. When you've got a difficult time, you need high-quality, experienced people in charge. And that's what we've got. After all, the UK is the largest international banking centre in the world. And we haven't got there because we do things badly. We've got there because we do things well.
So what should the bankers be doing to protect us from future crises? Perhaps they should be more prudent with our cash.
What you do is that as you approach a situation where an economy is going strong and there's an awful lot of lending, you require banks to keep more money in reserve from which they then lend. You require them to have more reserve assets at a time when the economy is strong than when the economy is weak. It's not really a very complicated idea, and I think it's one that the world's central bankers should think hard about.
If the government and the regulators don't seem tough enough, there's another possibility. The shareholders in the banks should take more action to hold the chief executives to account, to stop them putting our finances at risk by gambling our money on risky loans.
They can't just sit idly on the sidelines and watch chaos develop. They need to get involved with actively managing their investments, because with shareholder ownership becomes responsibility. And the bigger the ownership, the bigger the responsibility. But that's a relationship which in this country, I'm afraid, is broken down.
People aren't happy with the performance of their banks, but is there an alternative, such as a credit union? They might not have all the products and facilities of high street banks, but credit unions keep your money safe and the members are in charge.
Well, I suppose what credit unions and banks share in common is that they are about financial services. They're a place where you can save money, they're a place where you can borrow money, and a whole range of other financial services like current accounts in some cases. But what makes them different is the way in which they're owned. They're actually owned by the people who use those services, and those owners can actually go onto the board of directors and get involved in running that credit union and saying how that credit union develops, the types of things that it offers its customers, and that makes them very, very different from banks.
We're asking people how they feel about their high street bank and if they'd be interested in a credit union as an alternative.
Is it a concept that you would be interested in moving from your high street bank to something like a credit union if you felt that they were going to charge you less for the same services?
Yes, certainly.
If I said to you that there was an alternative to a high street bank where they're not going to charge you in that way and where you might get better savings results...
It's a good sales pitch, I like that.
Would you consider moving your high street bank account to the credit union?
Yeah, probably, yeah. Well, now there are over 400 credit unions, and there's coming up to about 700,000 people in a credit union. Now, that doesn't seem like a lot, but over the last few years, the number of people who've joined a credit union has doubled, and we expect that to continue growing at that rate over the next few years.
In our little experiment, 52 people expressed an interest in joining a credit union as an alternative to a bank in only 2 hours. So, what has the credit crunch taught us about the behaviour of the big banks? That they can always make their money back, and the bosses nearly always get big bonuses, whilst the rest of us are forced to pick up the bill.
I think at the top of banks, it's very easy for senior executives to make sure they don't actually fully debate and discuss critical issues and expose themselves to criticism. They tend to attract people around them who are sycophants.
I think it's an incredible injustice that very senior executives, banks and boards who've gambled with banks' money now expect either the ordinary depositor or the ordinary taxpayer to refill those coffers either through higher interest rates, the impact on individuals' household bills, or through an underwriting from the taxpayers. It must be one of the most grossly unfair systems you can think of.
We're now a year into the credit crunch. Mortgage rates are up, house prices are down, homes are being repossessed. Yet not a single chief executive of a top 5 British bank has either been given the boot or fallen on his sword. Instead, bankers still continue to collect obscenely huge bonuses, whilst the rest of us suffer the consequences of their actions. And if the banks never lose and are never held to account, then there's nothing to stop this all from happening again.
Hoping to restart the heart of Castleford, Kevin MacLeod and the Big Town Plan, next.